Hello and welcome to Nomura's Week Ahead podcast series. I'm Dominic Bunning, head of G10 FX strategy here in London. With our regular podcast on pause over the holidays, we've instead lined up a series of specials focusing on the macro outlook for 2026. In this episode, I'll be joined by my colleagues in New York, David Seif, Aichi Amamima, and Ruchir Sharma to discuss what to watch out for in the year ahead in the US and Canada. After a solid year for the US economy in 2025, albeit one punctuated by policy volatility, our team will outline why we see another year of above-trend growth, sticky inflation, but still the scope for 2 more Fed rate cuts. We'll also discuss the key risks for both the US and Canada over the next 12 months. It all sets up for a fascinating chat, so with no further ado, let's get stuck in.
Well, I'm very happy to be joined by David, Aichi, and Ruchir. We're going to start with David. First things first, can you just give us the headline views on the US economy for next year? What do we expect in terms of growth, inflation, and the Fed funds rate?
Yeah, great to be back here, Dom. First of all, we expect growth to accelerate next year, driven in large part by easing headwinds and additional fiscal stimulus from the OBBBA. The bottom line is that gets us to 2.4% growth for GDP next year. Not only is that higher than 2025, but it'll actually be, if realized, the 4th consecutive year in which U.S. growth is above trend. Now, as a result of that, as a result as well from stickiness due to tariffs, we expect inflation to remain closer to 3% than to 2% throughout the course of the year. We should see it start to drift lower by the time we get to Q4, but it will be well above the Fed's target we expect for the majority of the year. Despite that, we think that the Fed is likely to cut rates twice in 2026. Now, we should be very careful here in differentiating what we think will be 2 different regimes for the Fed. The first is the Powell Fed, which has the first 3 out of the 8 meetings of the year. And here we expect no future cuts. So we think that the Fed is done cutting rates under Powell, despite the fact that the December cut was not really very much of a hawkish cut at all. It still is likely to be strong enough economic data to prevent them from cutting. However, beginning in June, we expect 2 more cuts under much more dovish Fed leadership. We have those cuts penciled in for June and September, and that would bring the Fed funds rate down to 3 1/8 from the current 3 5/8. One other thing to also focus on is that we have an out of consensus view on the unemployment rate, which is that we expect it to fall throughout the course of 2026. And this is driven by both an increase in labor demand, which we expect to really pick up after Q1, as well as a reduction in at least some of the headwinds to labor supply.
Brilliant. That's really clear, David. I want to get into a bit more detail on some of those points. So let's start with the sort of growth outlook. As you mentioned, above trend is our expectation, certainly on the strong side of consensus as well. Aichi, from your perspective, what are really the key driving forces behind that growth story? Is it about fiscal? Is it about a strong consumer? David mentioned the labor market as well. Or is it just a bit of everything? What is really driving this story from your view?
Yeah, so first of all, the key drivers for economic growth next year are changes in economic policies. So new tax cuts embedded in the OBBA, One Big Beautiful Bill Act, will likely boost economic activity. And also de-escalation of U.S. tariff policy will likely reduce economic uncertainty, normalizing business operations, including hiring and business investment. On top of that, monetary policy will likely exert a positive impact on the economy, based on the lagged impact of the past rate cuts and also future expected rate cuts will likely be positive for the economy. So overall, fiscal, monetary, and tariff policies all point to better economic growth next year. Moreover, in the private side, so the AI investment will likely accelerate further next year. If you look at the planned investment by big tech firms, we will likely see further growth in AI investment. So by component of GDP, better business environment will likely boost private capital expenditure. So overall, we expect a CapEx-led economic recovery next year.
Okay, it sounds sort of pretty broad-based. One thing that's been coming up a little bit in various discussions, and New York Fed President Williams spoke about it recently, is this idea that maybe the economy looks a bit K-shaped, that sort of one part of the economy is doing quite well, maybe the lower part of the economy, the less lower income households are maybe not doing quite as well. I know you've written something on this in the Outlook that we published recently. Ruchir, can you maybe talk us through what you make of that K-shaped economy argument and where you think maybe it doesn't quite hold up?
Yeah, so taking a step back, even with all the headwinds, the consumer has actually been pretty resilient through 2025. And look, going into 2026, we still think that consumption holds up. So you've got easier monetary policy coming through and a fiscal tailwind from the OBBA, as David and I mentioned. So as you said, there's been a lot of talk about a so-called K-shaped economy, the idea that only high-income households, they're doing well while everyone else is struggling. So Fed officials, including Chair Powell and New York Fed President Williams, as you mentioned, they flagged low-income consumers as a potential vulnerability. So it's not a fringe concern. It's a fair question. But when you step back and look at the data, that story feels a bit overstated in our opinion. There are clearly some soft spots, but the conviction around a K-shaped economy has really run ahead of the evidence. So income and spending data actually point to a fairly broad-based strength. Inequality hasn't widened in recent years, and in some measures, it's actually narrowed. And if you look at wages, so lower paying sectors, they've seen faster cumulative growth since 2019. On the spending side of it, lower income consumers, they've also held up better than many people think. So the BEA's income by income spending data, it actually goes up only through 2023, but up to at that point, lower income households, they were outperforming. And more recently, surveys like the New York Fed's one, it shows that spending growth looks pretty similar across the income groups. And even sentiment data, which doesn't necessarily line up cleanly with spending, but it shows a smaller gap between high and low income households than we'd normally expect. So some of the K-shaped argument, I think that's focused more on financial stress, things like rising credit card and auto delinquencies. Those have ticked up, but the Fed's own financial stability work suggests that this was more of a normalization following a period of looser underwriting, and it's not a sign of acute stress. And then you also have bank earning calls to back that up. And interestingly, New York Fed's consumer survey shows rising credit stress among more among middle and higher income households, not the lowest income group. So yes, income inequality in the US, it's still very high by global standard, but that's a long-standing structural issue. There's not much evidence that it's gotten worse recently, or that today's consumer strength is being primarily driven by the top end of the income distribution.
Okay, brilliant. So, I mean, it sounds all generally pretty optimistic, I think, from all the different angles we've covered there. Moving away from that growth story, clearly that's going to, as David mentioned, feed into inflation. That said, there is a lot of debate, I think, even amongst the Fed about what is really driving inflation. Is it tariff-driven? Is it an underlying strength of the economy? I'm really interested to kind of get your view on this. What do you think is really driving that inflation story, and how do you see that progressing through the course of the year?
So I'm going to talk about inflation. So first of all, the core PC inflation currently stands just below 3%, well above 2% Fed's target, over 2%. And we estimate higher tariffs boosted core PC inflation by 40 to 50 basis points, roughly speaking. So our sense is that the underlying inflation is about 2.5%, roughly speaking, after adjusting for the impact from tariffs. So looking ahead, the lagged effect of past tariff increases will likely materialize further in Q4 this year and early next year. So however, beyond Q1 next year, we expect the impact of tariffs to start waning, pushing down goods price inflation. So, we are a little bit relatively optimistic about a goods price disinflation next year because of de-escalation of tariff policy. By contrast, our major concern is about the service inflation. So we expect the disinflation of service prices to be very, very gradual next year. As for rent and owner's equivalent rent, we think a rent disinflation will likely be very gradual. So although inflation of new market rents came down recently, it takes some time for lower new market rents to feed into offshore rent data of CPI, PCE, as a majority of the sample units used for estimating offshore rent data are basically existing tenants as opposed to new tenants. So this lack of rent inflation between new leases and existing leases seems to be getting longer, partly because of reduced mobility of renters. Also, single-family markets remain relatively tight compared with apartment markets, which will likely make owners equivalent rent stickier. Because the sample of owners equivalent rent is weighted towards the single family units. So lastly, core service inflation excluding rent, so-called super core service inflation, will likely remain very, very stable due to resilient wage growth and some other factors, including an increase in the reimbursement rate for Medicare physician service prices next year. So importantly, we expect labor markets will pick up as the broader economy improves next year, so which should support wages and hence super core service inflation. So putting all together, like a goods and rent and the service super core service components, so we expect core PC inflation to remain well above the Fed's target of 2% even at the end of next year.
Great, thanks, Aichi. Now, putting my Econ 101 hat on, when I hear above trend growth and above target inflation, I'm certainly not thinking that rates need to be cut. But obviously, David, you mentioned at the top of the show that we do expect the Fed ultimately to cut later in 2026, but it's probably going to be a game of two halves. Really interested to hear kind of how you go about analysing the Fed, their reaction function, and obviously, how is that going to change through the course of the year?
Yeah, well, first of all, Dom, I think that's a solid Econ 201 right there analysis. So great job on that. We definitely do think it is a year where the dynamics of the Fed are going to change significantly. And I think the question is how much it will change. But at a minimum, we think that Powell is likely to be replaced with somebody who is significantly more dovish. Now, Powell arguably has not really shown all that much hawkishness in an absolute sense. Inflation has been above target for years. The labor market has been relatively strong and continues to be right now, and yet the Fed has cut rates quite a bit over the past year and a quarter. All that said, we think that the reaction function that the Powell Fed has would not lead them to cut rates given the amount of strength we see in the labor market and in inflation. But we do think that a Trump-appointed new Fed chair, whoever that may be, is likely to shift things. So right now, we have 2 more rate cuts in there, and I think it'll be worth talking about later in this podcast what risks there are to that and how far that change in Fed dynamics could go.
Yeah, absolutely. We'll definitely get onto the risks shortly, but we don't want to be too US focused. We do also have Canadian economic forecasts, and Rashir's on the line to cover some of that. So Rashir, Canada's had a pretty tough year, I think, in 2025, but it does seem like we're getting some signs that maybe things are past the worst. Is that a fair assessment? And where do you think growth, inflation, and ultimately interest rates in Canada are going to head in 2026?
Well, I agree with your assessment, Dom. 2025 was a pretty tumultuous year for Canada. So President Trump's aggressive trade actions hit growth, injected new volatility into a labor market that had been stabilizing, and it raised risks around the BOC's sustained disinflation process. But as you said, heading in 2026, I'd describe Canada as being in a phase of slow rebuild. So business investments and capex, which has long underperformed in Canada, they're likely to recover, anchored by public sector commitments, and they should gradually drive a rebound in growth. So unlike the US, Canada doesn't have a big monetary or a fiscal stimulus coming online. So consumption, on the other hand, is likely to be steady but fairly unremarkable. So coming to exports, I think that's a brighter spot for Canada. Canada's been actively trying to diversify away from the US, reaching out to Europe, China, India. And I think another big spot that would be in focus is the USMCA. That would be the front and the center. So we think there's a decent chance that Canada secures a deal. A large share of imports are already USMCA compliant, and I think that President Trump has shown increased sensitivity to affordability concerns, which in my opinion limits how far trade escalations can really go. So on top of that, Canada has actually ramped up defense spending to meet the NATO's target, and that creates room for deals. So whether through a higher U.S. defense imports or participation in continental security initiatives like the Golden Dome that President Trump has floated. So coming to inflation, we think that price pressures would continue to ease. Core inflation measures, they've remained within the BOC's target range, and I think they're going to remain within their target range of 1 to 3%. And primarily, the market rents are still falling, and Canada has dropped retaliatory tariffs, which should keep the goods prices in check over there. So against this backdrop, and using Governor Macklem's quote, I think that this growth and inflation outlook should keep the BOC on hold comfortably through 2026 end.
Brilliant. I mean, it's very interesting in Canada, kind of the market almost flipping its view quite quickly at the back end of this year from pricing rate cuts to even starting to price rate hikes, which is a sort of theme we're seeing across developed markets, but obviously not for the US, but certainly a risk to focus on elsewhere. But talking about those risks, I just want to finish off really by going around the room and asking you guys, what do you think are the big risks to your view? And they could be an upside risk or a downside risk. But Aichi, I'd love to start with you. What do you think is the biggest sort of risk factor out there that maybe markets aren't as focused on as they should be?
So there are so many risks. So for me, let me talk about a couple of risk scenarios. One is we see some risk of re-acceleration of inflation. So although tariff-induced price pressures on goods prices will likely wane, demand boosts from both fiscal and monetary policies should increase the risk of re-acceleration in service inflation. So inflation has been above 2% almost 5 years. And a second wave of inflation shocks after the pandemic-driven surge in inflation could make above 2% inflation entrenched. So another risk is a jobless recovery. So our base case is that the labor markets will improve along with the broader economy. However, if the broader adoption of AI techniques could reduce the labor demand, and then which could lead to a jobless recovery. In that case, Fed could react to the weak labor market data and by cutting rates more. And then even if the weak labor markets are basically structural phenomena as opposed to cyclical phenomena. So and also we see some risk of more fiscal stimulus. So President Trump is talking about a $2,000 paycheck, which is so-called the tariff dividend. So that is not a base case, but given the midterm election in November next year, we cannot rule out the possibility of more fiscal stimulus. That's it from me.
Okay. Rishi, anything from you on the risk side you wanted to add?
Yeah, I think even if the broader direction of trade policy that looks fairly benign, the big risk, in my opinion, is re-escalation. So we've already seen how volatile things can be with China. And while the US-China truce is meant to last a year, there's a real chance here that tensions flare up well before the window closes. And we've also seen that tariffs were used much more explicitly for geopolitical reasons this year. In some cases, tariffs were raised specifically, like 50% tariffs on India and Brazil, not because of trade balance issues, but because of broader geopolitical concerns, including ties with Russia. And as recently as this week, we saw that the administration was considering all the tools at its disposal to address the digital tax concerns by EU. So then there's this risk. And finally, there's the USMCA that I mentioned. So it's up for review by July 2026. And that's an important risk point because right now, the USMCA compliant imports from Canada and Mexico are largely exempt. But that exemption doesn't guarantee to stay as broad as it is today. And through the review process, there's a possibility that the scope of those exemptions gets narrowed. So even without a full-blown trade war, there could be periodic flare-ups, and that remains a meaningful risk.
Okay, brilliant. Certainly something to watch in H2 there with the USMCA for sure. David, finally coming to you, what are the big risks or the big risks that you're focused on for this year?
Well, I think it's worth focusing on risk to the Fed and the Fed's dynamics. And I think these are actually two-sided risks, meaning both to the dovish and to the hawkish side. On the dovish side, I think there is a risk that not only will the new chair be more dovish, but that due to replacements of governors on the Fed, either because the Lisa Cook firing case succeeds or because governors decide to resign and are replaced by more dovish alternatives, that the Fed lurches much more to the dovish side than even we expect. And that could lead to additional cuts. I think it could also lead to a potential loss of credibility for the Fed, which, if that were to occur, could actually lead to a steepening of the U.S. yield curve in a way that would be representative not of higher growth expectations, but of higher inflation expectations. But of course, this risk is two-sided, and what we have seen from the Fed for the past 40 to 45 years has been almost a de facto dictatorship of the Fed chair. What the Fed chair wants, the Fed chair gets. And I think that there is the risk that if the new Fed chair tries to push through more cuts than the committee is willing to accept, that dynamic changes and you get increased pushback from Federal Reserve voters or FOMC voters. That could lead to not only more dissents, but in a more extreme case, the possibility of the Fed chair, him or herself, being outvoted. And we do have situations where the head of the central bank is in a much less powerful position relatively than the Fed chair is. And I think a perfect example of that is the Bank of England, where it really is one person, one vote. You get 5 to 4 votes all the time among the 9 members on the MPC. And it was less than 20 years ago that then Governor Mervyn King was actually outvoted. And I don't think anyone would be totally shocked to see Andrew Bailey outvoted in a vote at some point. So that could actually mean that there are fewer Fed cuts than we expect, and could also lead the analysis of how the Fed operates and what the Fed will do to have to be totally different going forward based on this new dynamic.
Well, that's it for this special edition of The Week Ahead, which was produced and edited, as always, by John Dalton. Thank you very much for listening. You can like and subscribe to The Week Ahead series through the usual podcast channels, Apple, Spotify, SoundCloud. And if you want to leave your feedback in the comments, we'd love to hear your thoughts on the show. Please do feel free to share this podcast far and wide with anyone you think might be interested. You can also log on to nomuraconnects.com for more information. Thanks once again, and we wish you all the best for the year ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.